Welcome back to our channel. Today, we'll explore the important topic of correcting errors in financial statements. Understanding this process is crucial for maintaining the integrity and reliability of financial reports. Let's dive right in. Errors can arise in respect of the recognition, measurement, presentation, or disclosure of elements of financial statements. Financial statements do not comply with IFRS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flows. Errors in financial statements can happen in various ways, such as how items are recognized, measured, presented, or disclosed. It's essential to correct these errors to ensure compliance with International Financial Reporting Standards, IFRS. Let's break down the types of errors. Recognition errors, incorrectly recording transactions or failing to record them. Measurement errors, miscalculating amounts, such as depreciation or inventory valuation. Presentation errors, misclassifying items in the financial statements. Disclosure errors, omitting or misstating necessary information in the notes to the financial statements. Financial statements do not comply with IFRS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flows. Intentionally misstating information, whether material or immaterial, to achieve a desired outcome is a serious issue. Such actions can mislead stakeholders and undermine the credibility of the financial statements. Potential current period errors discovered in that period are corrected before the financial statements are authorized for issue. If you discover errors during the current period, you should correct them before finalizing and issuing the financial statements. This ensures that the most accurate and reliable information is presented. However, material errors are sometimes not discovered until a subsequent period, and these prior period errors are corrected in the comparative information presented in the financial statements for that subsequent period. Sometimes, material errors are not identified until later periods. When this happens, these errors need to be corrected in the comparative information of the financial statements for the period in which they are discovered. Here's how to correct material prior period errors. Restate comparative amounts. Adjust the figures for the period in which the error occurred. This means updating the previous period's financial statements to reflect what the amount should have been. Restate opening balances. If the error occurred before the earliest period presented, adjust the opening balances of assets, liabilities, and equity for the earliest period shown in the financial statements. Let's look at some practical examples to make this clearer. Scenario: a company discovers it failed to record a significant purchase in the previous year. Correction: the company should adjust last year's financial statements to include the purchase, thereby correcting the comparative amounts. Scenario: a company realizes it miscalculated depreciation for its equipment over the past 3 years. Correction: the company should restate the depreciation expense for each affected year, updating the comparative amounts and the opening balances of the current period. Scenario: an entity misclassified a long-term liability as a short-term liability in the previous year. Correction: restate the prior year's financial statements to classify the liability correctly, ensuring comparative figures are accurate. Scenario: a company failed to disclose a contingent liability in its previous financial statements. Correction: update the notes to the financial statements for the prior period to include the necessary disclosure. In summary, correcting errors in financial statements is crucial for transparency and accuracy. Whether discovered in the current period or a prior period, these corrections ensure that stakeholders receive reliable information. Remember, maintaining the integrity of financial statements builds trust and supports sound decision-making. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel for more insights on accounting and financial reporting.